without any further ado, the new financial geopolitics, how long can the US keep going as a lender, leader and reserve asset of last resort? First panel, contending perspectives. Sylvia, please take it away with any other introductory remarks you would like to make.
Great. As usual, Mark summed it up, but Iain and I have been working on a fairly challenging for us project for some years, and we thought getting a bunch of smart people in the room would help us continue to refine our ideas. So thanks, Mark, for being willing to pick up on my idea. I think we'll get started.
Okay, I will start. I'll claim this as a keynote. The arguments that we're making really can be summed up in this slide. You'll all be very well aware of the dark blue line, the cumulative current account deficit of the US, the sum of the trade deficit and the US's net investment income, the ability of the US to delay adjustment of the current account deficit. Two things I think that we have tried to focus on. One is the puzzle between the cumulative current account deficit and the NAIP, the measure of the US international indebtedness. And as we see it, and I don't want to say too much about that given Puneet, I presume, will say a lot about this as well, but for us that's basically the valuation gains, the unrealized valuation gains on the other two parts of this diagram, which is the US international assets, the grey line at the top, and the US international liabilities, the orange line maybe, at the bottom. And what we see is that these valuation gains, the unrealized valuation gains on the external balance sheet, have been often positive for the US, particularly positive for the US in the period before the financial crisis, when essentially we saw a divergence from the usual situation where the valuation gains essentially tracked the NAIP. But increasingly since the financial crisis, that what we've seen is this working against the US, increasing the US indebtedness, despite, to lift a quotation that Daniel used, the economist seeing the world as having rebalanced. So the US has gone from a situation of an NAIP of about $1.25 trillion to an NAIP of approaching $8 trillion. And the main contributor to that has been these valuation changes working against the US. And for us, that's the key issue that we want to examine. And what that brings you to is a consideration of the assets and the liabilities in total of the US. And obviously that's mirrored by the rest of the world, because this is the external balance sheet of the rest of the world also with the US. And even excluding derivatives, these assets and liabilities are 3 times larger than they were in 2002. So for us, essentially, the question is almost, how could this not be important? And if you accept that they are, then for us, we need far greater attention on the US as investor as well as borrower. The assets are important as well as the liabilities, both gross and net. And Europe as a key counterparty is important as well as Asia.
So it's not just the size of the external balance sheet that is important analytically when trying to understand the basis of U.S. monetary power and that the interests of others, but it's the composition of the balance sheet. So the standard way of seeing the U.S. balance sheet and explaining the paradox of of U.S. exorbitant privilege is that the net income the U.S. gains from its assets on the balance sheet is higher than the costs of the liabilities on the balance sheet, because the U.S. is long risky assets, equity and FDI, and short safer assets. And this is a standard way of looking at things. It's I think, been brought to political economy by Herman probably 10 years ago now, right, in your book? When was your book? Seems moments ago. So U.S. assets are, on the asset side, 2/3 of the assets are FDI and equity, so the risky assets that the U.S. is long in the stereotypical view. And on the liability side, it's only 50% FDI and equity. But if you actually look at the magnitudes, the aggregate values, 2/3 of 21 billion on the asset side is 14 billion, and 50% of 28 billion on the liability side is 14 billion. So the main takeaway from this slide is that we're not there yet, but we're moving towards a position where the U.S. is not long risky assets, FDI and equity, and short debt, but actually moving closer to being net in balance on the risky asset portion of the external balance sheet and short debt, right? So we're still earning more rent from that long risk, short, safe assets than we were pre-2004. You can see that here. Obviously, you know, the stereotypical view of the U.S. earning great rents from its balance sheet position is related to that hockey stick rise from 01 to 06. But you can see we've been trending back down.
So what? This is a chart showing the changes of the US NAIP since 2006, which is taken from some Fed pieces. The blue is the flows that finance the current account deficit. Should match exactly the current account deficit, but don't. And what we can see is the obvious declining deficit since 2006. And the orange and the grey blocks represent the net valuation changes on the external balance sheet. The grey is the change in the foreign exchange movements, the US losing if the dollar appreciates and gaining if the dollar depreciates. And then another darker orange is the movement in other market changes. And what you can see is increasingly, as time goes on, the valuation changes are a greater contributor to the changes in the NAIP than the current account deficit. And the trend appears to be a declining current account deficit, and as we've already said, an expanding external balance sheet. That's not to say that the current account trend should continue, but certainly everything points to the external balance sheet trend continuing. So that's not to dismiss the positive impact on economic growth of the flows that finance the current account deficit, but it's to argue that these flows are only part of the story that we have to be thinking about. On the valuation changes, the US can win or lose, and obviously in recent years, as you can see here, the losses tend to be greater than the wins. And the irony here is that for all the attractions of the US dollar and the US financial markets underpinning the key currency status, the US gains when the dollar is weak and when US assets are doing worse than assets in the rest of the world. In other words, the rest of the world as an investor has to get it wrong on the US for the US to gain. And particularly, the global investors, the rest of the world, will do well when at times of financial crisis. Hence the US insurer role when the dollar rallies, US Treasuries rally. We know that story from the financial crisis. But as you can see on the chart, it doesn't need financial crisis for us to be in a position where the US loses. If you look at dollar strength in the 2014, 2015 period, that does the trick also. The US ends up as a loser. Our main point, however, is not that the valuation changes that are going to always work against the US. Sometimes the US will win, sometimes the US will lose. But the point here is that these valuation changes are the results essentially of overwhelmingly private sector financial actor decisions. And what we're looking at is essentially a loss of US autonomy. The US autonomy that underpins what all of us see as the bedrock, if you like, of US monetary power. The second part of the so what question is clearly the implications of the increases and decreases in the NAIP. Essentially what these are to use Gerinchis and Ray's term, is wealth transfers into and out of the US. And these wealth transfers can have either positive or negative implications for relative economic growth, US relative economic growth with the rest of the world. As Herman says quite rightly in his paper, we can't simply assume that if the flows are less than the wealth transfers, then the wealth transfers in terms of their impact on economic growth are greater. That's not what we're arguing, and it wouldn't make any sense to do so. And calculating if we've reached some sort of crossover point at which the positives of the flows are outdone by the negatives of the valuation changes would obviously be an enormously difficult task. And again, going back to Herman's paper, quite rightly he points to, and I think at least one other paper does the same, we have to look at the sectorial implications of who's winning and who's losing. So we have got a roadmap of how we might go about doing that. Various papers from Lane and Shambaugh do that. But in a sense, that question's beside the point, because what we're really focusing on here is the loss of US autonomy, as I've said. And clearly the potential for wealth transfers is not only an economic question, it's also a political question. We see the political salience of that in a number of different issues. We see it in Chinese concerns about their treasury investments. If there's no implication in wealth transfers, why care about the potential for the dollar to devalue? We see it in arguments about supporting non-US counterparts with the Fed and rescue of AIG, for example, in the financial crisis. We see it within the Eurozone, as a number of people have pointed out in their, in their papers. And our argument is that we need to add external balance sheets to our existing frameworks.
So conceptually, one of the things that we're doing is trying to use the external balance sheet to bring an understanding of the U.S.'s sensitivity to its international financial entanglements. So, we used to talk about economic sensitivity at a national level in terms of trade, and we have very good data and accepted ways of measuring sensitivity to trade. You might argue that sensitivity to finance is the same as trade and services, and we can talk about that later. But we have tried to take a step forward in measuring sensitivity to these balance sheet valuation changes using data from Augustine Benetrix, Phil Lane, and Shambaugh. I tried to get all three of them to be here today, and at one point each one of them had committed to coming, and various things came up, being paid exorbitant amounts of money to consult for central banks and things like that. So we have taken a database of theirs and a measure called net FX, which takes the exposure of any nation's external balance sheet to a uniform movement in the domestic currency of the country, and it multiplies that by a measure of international financial integration. So it's weighting the sensitivity of a country to a currency-driven change in valuation on the balance sheet, standardized by the amount of financial integration, which is measured simply as assets and liabilities on the external balance sheet over GDP. And so what you see here is a ranking of countries based on that, using that data and focusing in on net FX. So very interestingly, U.S. trade sensitivity, we all know, is low. It's gotten higher than it was in the 70s. It's still relatively low. U.S. financial sensitivity is not so low. It is here in the middle of the page. So the U.S.'s IFI, its international financial integration, is relatively low, but its sensitivity is fairly high. It's similar to China's. Now, this ignores some nuance, but the sensitivity favors dollar weakness for the U.S. The U.S. is not unusual in being short its own currency, which is partly what's driving this effect. But we'll talk a little bit more about that later. But this result is the consequence of foreign currency denominated assets exceeding foreign currency denominated liabilities. And so you can see the effect on here on the U.S.'s sensitivity to financial asset valuation changes on the external balance sheet.
Okay. So, picking up on that and starting to look in particularly at questions of interest in foreign exchange values, and the key thing that I think the if you like, an external balance sheet approach allows us to do is to raise a further issue with the dollar, which comes out in a lot of discussions, particularly obviously on the importance of liquidity provision, which we would argue doesn't then be taken into a lot of the questions around the interest. So the general perception of interest is everyone has an interest in the dollar because, or in the rest of the world, because everyone is long the dollar, everyone is invested in the dollar. To us, that tends to ignore an important additional point about the dollar as key currency, and that's the role of the dollar as a borrowing currency. You can see that in terms of the sensitivity of the U.S. And other countries to the weakness of the domestic currency. We can see that in the previous slide. Now we're trying to look at not only the interest in domestic currency weakness, which is, as we said, is shared by pretty much all the countries that we would be interested in considering, but also in terms of interest in the strength or weakness of particular currencies. In other words, what we're trying to do is look at this as a window into questions around the dollar trap. And what the figures suggest, and as even those who put it together would have in writing acknowledged, these are preliminary figures, but what they show is that the US is a far more dominant borrowing currency than it is an investment currency relative to other major currencies. And here, obviously, we're using euro, sterling, and yen, and that has a pretty significant impact on interest in the dollar. Obviously, if you invest in the dollar, you have an interest in strength of the dollar, but if you borrow in the dollar, going back to things like the original sin literature, you have an interest in the weakness of the dollar. And we include Malaysia here to show what the implications of that and how that plays out, and not to claim Malaysia is massively important in any sort of dollar politics. But if you look at Malaysia, you see top line, the assets to GDP invested in the dollar are well over 50% of GDP. And you have an enormous amount of integration with, if you like, the dollar zone, the dollar global financial system. But liabilities are also over 50% of GDP. So we have the rather bizarre situation in the case of Malaysia, that it cares more about the strength of the euro, the euro and even sterling, than it cares about the strength of the dollar. And rather more important countries still maintain, particularly China being the important one, still maintain a strong interest in dollar strength, but it's mitigated quite substantially by liabilities also in dollars. And as Chinese corporates borrow more abroad, we would expect that to continue. So even in the case of China and Korea, the interest in dollar strength is far beyond the reserves that those countries hold. And Japan is particularly interesting because if you look at the dollar long, as we call it, it's only slightly bigger than the euro long. In other words, Japan has only a slightly stronger interest in dollar strength than it does in euro strength. And the reason is not exceptional investments in Europe, but the fact that the US is a borrowing currency.
So you can probably see where we're going. We have 2 minutes left. If you didn't get a chance to look at the paper online, it's called Whose Dollar Trap Is This Anyway? And the prior slide is really one that challenges the view that the dollar trap is that of Asia, holding all of these US Treasury bills and fearing the loss of value on the balance sheet from any depreciation in the dollar. So what we're trying to do here is actually pick apart through the balance sheet who's got an interest in dollar stability. And the point of the prior slide is Asia doesn't have as strong an interest in dollar stability as you might think. This slide shows that, for Germany, the interest is actually weak interest in dollar depreciation. Interest in dollar strength, surprisingly, in Europe is stronger in non-Euro Europe, in some of the northern European countries, for example. So where we're driving towards here is deriving from this analysis of sensitivity to changes in the valuation on the external balance sheet for key countries in the world, G8, if you will, driving that from this careful analysis of net FX. And this slide that Iain's going to briefly talk about sums that up, and then I'll conclude very quickly.
Very, very tentatively. So if the US sought a weak dollar, what would the external balance sheet, if you like, the politics of external balance sheets suggest might happen? We don't challenge the view that we would expect China to oppose, but the UK and Canada should care far more. Japan's interest in the dollar, as I've already said, over the euro is at best marginal. And the euro area economies, and here obviously we're pushing rather what the definition of a domestic currency is, and there are other issues clearly involved, but the euro area is largely indifferent about the dollar, whereas the US is fairly strongly concerned about the strength of the euro, and is also cares about the strength of sterling. There's missing currencies in the US data, but nevertheless I think this is valid. And hanging over this, of course, is whether the US actually could engineer such an outcome, a devaluation anyway.
So quickly summing up, we've done this deep dive into the data. The point of that is to say that the dollar's role as a borrowing currency substantially reduces counterparties' interest in dollar strength. Three other points. The increasing size of the U.S. external balance sheet reduces U.S. international monetary power because it reduces U.S. autonomy, particularly shifting the balance of impact to the private sector. The dollar's role is, there's a paradox here because the dollar is a safe haven currency. So when there's a risk-off trade in the world, the U.S.'s external balance sheet net position deteriorates. And that points to some significant instability that will come home to roost, maybe not in the next 5 years, but at some point. And then the final point is that Europe, including the United Kingdom, needs far more attention in our discussions of the evolution of U.S. international monetary power than perhaps we give it. We tend to talk predominantly about the U.S.-Asia nexus. And if you look at who would be in alliance for dollar stability, the UK and Canada surface as having perhaps among the strongest and surprising interest in dollar stability, certainly compared to China, whose interest is not as great.
Thank you very much. Over to you, Dan.
Okay. Well, thank you, Mark, for inviting me, and I'm going to reciprocate by not having any slides whatsoever and apologize for that. And I'm also going to fall into the trap that Sylvia and Iain have laid, which is I'm going to talk about the U.S. and China primarily and ignore everyone else. But that said, I'm happy to talk here because this actually forces me to revisit a paper I wrote back in 2010 where I basically argued everyone who's hyperventilating about the future of the dollar is crazy because the dollar as the reserve currency is going to be here for a while. And I'm very rarely right about these things. So 7 years later, at least I feel reasonably confident about that, at least to date. The question is going forward. But it highlights the fact that basically people have been worrying about the status of the dollars, of the dollar as the reserve currency of the world since well before, in fact, the 2008 financial crisis. Indeed, some very smart people in this room have written about the precarious status of the dollar prior to 2008. And then post-2008 financial crisis, there was a great deal, at least within Washington, of hyperventilation because China was doing things like creating the new development bank with the BRICS, or creating the Asian Infrastructure Investment Bank, or the CIPS. Is it CIPS or KIPS? I have no idea what the acronym is pronounced. But the Chinese International Payment System. It's worth reading at least Larry Summers' quote, because I like it when Larry Summers hyperventilates. When the AIIB came to fruition despite U.S. opposition, Summers wrote the following in both the Washington Post and the Financial Times. This past month may be remembered as the moment the United States lost its role as the underwriter of the global economic system. I can think of no event since Bretton Woods comparable to the combination of China's effort to establish a major new institution and the failure of the United States to persuade dozens of its traditional allies, starting with Britain, to stay out. And to be fair, there were some valid reasons for this kind of hyperventilating, which was first, the concern that the reaction to the 2008 financial crisis itself and the notion that the U.S. was at the epicenter would cause a variety of other actors to think we need to find ways to say never again, essentially, to make sure that we don't get affected by the crisis. And then second, and this is somewhat more recent, is the new U.S. addiction to financial sanctions, which is the idea that the U.S. can use the fact that it's at the epicenter of global capital markets as a way of employing targeted financial sanctions against actors that it does not like. Most of these actors were relative small fries, even Iran, for example. But then when the U.S. went after Russia following the 2014 annexation of Crimea and intervention in eastern Ukraine, you suddenly started seeing great powers thinking, well, if they can go after Russia, who else can they go after? And the idea that there might be the need to develop alternative payment systems. So without going into too much detail, the paper argues that basically most of this actually is hyperventilation, that if you take a look at the actual, the prospect particularly of China creating an alternative financial order that would legitimately challenge the sort of dollar-based system, most of, when you look under the hood at the New Development Bank or at the AIIB or even at the Chinese International Payment System, it's not all that impressive, that there is without question some degree of hedging going on. But neither the BRICS Bank nor the AIIB are particularly large and are large enough to really challenge the Bretton Woods institutions. And indeed, with respect to SIPs, you've actually seen a decline in the use of the renminbi over the past year or so as an international currency, as, among other things, the renminbi has declined in value, and people have begun to question the degree to which China's economic power or economic growth is going to continue as it was thought to be before. So this leads to a couple of questions, which is, first, why has there been such a freak out about this over the last 10 years? And here I would argue there are two reasons, essentially. The first is, and this is a point that I'm shamelessly stealing from Randy Schweller, is that, as Randy points out, essentially when you're in a system where there's a sort of a hegemonic order, as it were, or an order that is essentially being built by the hegemon, there's extreme sensitivity to any kind of delegitimation effort, even if that delegitimation effort is almost purely rhetorical in nature. Because, as Randy points out, only in a hegemonic system does balancing seem like a revisionist act. If you're in a bipolar world or if you're in a multipolar world, balancing is just thought of as a part of life. But in a hegemonic system, any actor that seems to be taking steps that would somehow challenge the hegemon is genuinely seen as revisionist, and therefore there's a great deal of sensitivity to even initial steps in that direction. And so this is certainly, I think, what you saw in the case of China, because there were a variety of rhetorical moves done even before the 2008 financial crisis, but particularly after the 2008 financial crisis, in which it was thought that China was at least making some initial moves or nascent moves towards creating an alternative system. Then once you actually see the creation of the New Development Bank and the AIIB, it's not surprising that there, to some degree, you have people like Larry Summers freaking out. Even if, when you take a look at what's actually being done, there isn't all that much in the way of significant change. And I don't think that anyone's really been talking about creating a bank corps since the head of the Chinese Central Bank proposed it back in early 2009. The second reason, I think, for the freak out is that if you think about the sort of components of a global economic order, in some ways the financial stuff is easily the most observable. And so I think one of the mistakes that a lot of observers have made is the notion that therefore we can look at finance as a harbinger of what would be happening in other areas, as a way of thinking about whether or not there's actually going to be a collapse or a dramatic shift in the global economic order. And so here I think the paper then proceeds to think, well, let's think like a rational revisionist. which is to say, if you really do want to challenge or create an alternative to the existing global economic order, if you don't like it because you don't think you're getting enough of the distribution of payments and or you don't like it because you're not in charge, how would you actually try to go about reworking it? And there's sort of a Goldilocks problem here, I would argue. And so when I talk about sort of a hegemonic economic or global economic order, I go back to one of my favorite articles, which is Susan Strange's from 1987, where she talks about the pillars of a global economic order, namely being production, security, information and ideas, and finance. So if you think of those 4 or 5 pillars, I always think information and ideas are 2 separate things, so I'll say 5 pillars. If you think about it, and if you want to try to challenge it as a particular actor, you have a Goldilocks problem. If you challenge it too soon, while the hegemon is too strong, you will get punished, and you will get punished mercilessly for it. Think about the new international economic order in the 1970s, or think about France under François Mitterrand in the early 1980s. Or if you're too weak, even if there isn't necessarily a challenger, and you try to create an order, you will pay miserably for it. Here, think the United Kingdom in the 1920s when it decided to set up the gold exchange standard and try to bring the pound to par value as it was pre-World War I. On the other hand, if you wait too late, if you don't challenge it and you sort of let things slide, well, you run the risk of a great power war potentially, which is normally how these kinds of hegemonic orders have transitioned over time. So basically, the argument I make is that the dynamics about how you would want to challenge a global economic order strongly suggest that finance would be the last pillar you would want to challenge rather than the first. And this is so for a couple of reasons. The first is, in some ways, this goes back to my previous point, is that precisely because finance is so easily observable, in some ways, those movements are the ones that will be detected most immediately by the hegemonic actor and therefore potentially be subject to some sort of exclusion and or ostracization in a way that if you see moves in terms of protectionism and production or information and ideas don't lead to the same kinds of retaliatory effects potentially from the hegemon. The second reason is the sort of dynamic density of global governance, which is to say, again, it's more easily observable if you see an actor, and because finance is such a relatively dense web of global governance structures, it becomes very easy across a whole array of these structures to determine whether or not an actor is functioning as a responsible stakeholder or as a spoiler. And the last point is that I do think there are tipping point dynamics in finance that are probably less acute in places like production or information provision or even security. Indeed, in security, you often have the reverse, which is sort of balancing effects. And so as a result, the dollar will look like it's the reserve currency right up until the moment when it's not. And then, in some ways, this is where, again, I think one of the distinctions between finance and trade is in finance, you can see much more quick reaction. And therefore, in some ways, if I was the rational revisionist, the argument I would make is you don't want to challenge the financial order right until you have all of your other ducks lined up in a row, at which point then when you go ahead, it's going to happen, and it's going to happen relatively quickly. So as a result, I'm relatively sanguine about the status of the dollar. That does not mean I'm sanguine about the status of the U.S. hegemonic order, because, as I said, in some ways the problem is that you will only detect a change in the dollar's status until it's too late. That the other areas that you would potentially care about, namely whether or not production is centered around the United States, whether the United States continues to be the provision, the sort of intervener of last resort, whether the U.S. information order and or its ideological order remains unchallenged, those are the things that I would expect to see fall before you actually see any kind of challenge to the dollar. And in the end, I'm just going to reread a quote I wrote 5.5 years ago for Foreign Policy because it sounds so damn good right now. I say, quote, "The dollar is not going anywhere, unless, of course, the United States political system were to torpedo it through repeated acts of self-sabotage." Which does lead to my belief that if the dollar does fall, the fall is not going to come from an external challenge. The fall will come in some ways because the U.S. domestic political system generates so much uncertainty that you will eventually see external actors decide they have no choice but to try to take active steps to find an alternative because they can no longer rely on the dollar. And with that, I'm done.
Thank you very much. Megan, please.
right, I do have slides. I don't seem to have a mic. Does that work? Okay, excellent. Great. So I have a bit of a different perspective, given that I'm an economist sitting in an asset manager. So hopefully that will bring something to the conversation. Looking at the question of how long the U.S. Can actually lead, I think we need to actually take into account recent events. So I'd like to start by asking whether secular stagnation is dead and whether it died on November 8th, 2016, or not. I'm going to give you a spoiler alert on my answer for how long the U.S. can lead, and it's a long time, but not forever. So in terms of whether secular stagnation is actually dead, I'm sitting in an asset manager surrounded by investors who are nothing but happy about how the markets have been going. And their argument is certainly that secular stagnation is toast. This is a structural break. We've broken out. The U.S. is about to see much higher growth, much higher inflation, much higher rates. Everything is looking great. And there are some things to actually support that assertion. So I'll start with confidence. Both business and consumer confidence have been way up since the election. It's hard not to say there's a direct correlation between Trump being elected and consumer and business confidence soaring. I would highlight that I don't really believe in confidence fairies. They tend to last if economic data starts to support them, but otherwise they just flame out. But confidence has been looking great. This means broader. Business confidence has come in. The ISM manufacturing index has looked great in the United States. It's well over the 50 break-even point, so manufacturing production should be expanding nicely. And that has spilled over into global sentiment. So actually, PMI data has been looking great globally, least of all in Europe, where I think we got PMI data out this morning. France was almost at 60 for manufacturing PMI, which is which is a pretty impressive expansion. So this confidence in the U.S. has been spilling over elsewhere in the global economy. And of course, it's also fed through into markets. So the S&P 500 keeps hitting new highs. We had a little bit of a blip a few days ago off the back of the Trump administration maybe having difficulty passing its replacement for the Affordable Care Act. But generally, that was actually just a day blip. Since then, the markets have stabilized and continue to go up. So all of the so-called soft data in the U.S. is pointing towards much higher growth. I'm going to go ahead and challenge that by looking at the hard data. And I've mentioned I think confidence fairies tend to peter out unless they're backed up by the hard data. And so far, it's not looking like the hard data is really coming in. So this is just a chart looking at home sales. We're getting a pause in them. There's a lot of data out there on the housing market in the U.S. Some of it is suggesting we're seeing a turn. Some of it suggests that it remains buoyant. But this, in any case, suggests maybe we're seeing a turning point. And of course, given how many Americans own homes, that feeds into wealth and spending patterns. Consumer confidence, actually, even though it's pretty high, retail sales, it looks like it's kind of petered out. Retail sales have been pretty buoyant, nothing to write home about since the global financial crisis. But of course, the consumer's driving the recovery in the U.S. This recovery and every other recovery in the U.S., the consumer accounts for about 70% of our GDP growth. So retail sales look like they're actually turning. Average hourly earnings are actually back at zero, so real wages are massively subdued. And of course, that once again feeds into consumer spending behavior, which is underpinning this economy. And it's not just the U.S. consumer that seems to be petering it out. It's actually commercial bank loans that suggest that the business, that investment is also petering out as well. So we see that that's actually turned and continues to decelerate despite the election results. The one real figure that I think should make us the most bearish is the Atlanta GDP Now cast, the Atlanta Fed GDP Now forecast. They actually take into account hard data more than they do soft data, and it's been nothing but a downward revision for a very long time. So the Atlanta Fed now sees GDP growth coming in for the first quarter of this year, so the first quarter that the Trump administration has actually presided over. It's below 1%. That being said, GDP growth in the first quarter always looks bad in the U.S. for seasonal adjustment reasons, but still lower than 1%. That hardly suggests that we're really breaking out. And I would argue that the reason that we have all this hard data coming in looking pretty lackluster is that there are huge global drivers that just aren't changing. And they're certainly not changing as a result of a Trump victory in the U.S. So the first global driver is this notion that we have an oversupply of absolutely everything. So I'm going to go ahead and trash my entire field and say that economics was based on models that baked into them this idea that we have a scarcity of things. I actually think we need to rip up all of those equations and models because we have an oversupply of everything. Debt is one example of what we have an oversupply of, even though every level of every economy has tried to deleverage since the global financial crisis. Overall debt's just gone up. We also have an oversupply of macro liquidity, so not market liquidity, but central banks have been pushing unprecedented amounts of liquidity into the system. There's an oversupply of cheap labor globally. That started really when the Iron Curtain fell, but more recently, as China has industrialized and urbanized, we have this massive glut of cheap labor. India is next, sub-Saharan Africa is after that. That trend's going nowhere. So none of this is changed really by the victory of Trump in the U.S. Overall, in the U.S., productivity remains pretty subdued. You can argue that some of this is down to measurement, and I'm sure some of it is, but I don't think all of it is, and so we have a persistent problem of low productivity growth, and this goes not just for the U.S., but it's the problem in Germany, the U.K., Japan, basically the entire developed world. We lack productivity growth. There's very little in terms of proposals coming out of the U.S. government, at least, that suggests that actually we're going to change our long-term productivity. There are a few things that would make me more excited about growth in the U.S. If we actually saw them come through. Infrastructure spending, if it went to building schools, for example, then we could get a boost to long-term productivity after about 10 years. But unfortunately, based on how they're hoping to fund infrastructure programs in the U.S., building schools is not at all productive, and I don't think private companies are going to raise their hand to get involved in those projects, because private companies, unfortunately, like to make a profit. So unfortunately, I don't think we'll get those kinds of projects coming through. So in the absence of any shifts to our long-term productivity, I think the U.S. is fundamentally a 2% economy. We might get little sugar hits to the economy based on tax cuts or some deregulation, but overall, I think our potential growth is stuck at 2%. You've also got demographics working against us in terms of breaking out of this low growth, low inflation, low rate environment that we've been in. So in the U.S., we're suffering from an aging population. We're actually looking a lot better than most of Europe, Ireland accepted. Japan, of course, is looking the worst of anyone. I think 5 years ago, sales of diapers for elderly people exceeded sales of diapers for newborns in Japan. So that's a statistic worth paying attention to. So this is a major global driver. I don't think we have any policies being proposed in the U.S. or elsewhere in the developed world that will be able to overcome these massive drivers. That being said, we have had a big rebalancing from developed markets to the emerging markets. So you can see that the percentage of each contributing to global GDP based on purchasing power parity has actually swapped, so that developing countries are actually contributing more than advanced economies. So fundamentally, if you believe that the U.S. is a 2% economy, the Eurozone in aggregate is roughly a 1.5% economy, Japan is between 0.5 and maybe 1%. The global growth is going to have to come from somewhere, and it's probably going to come from the emerging markets. This is a trend that we've already been seeing for years and years, but I do think that's going to continue. The question is, when will we hit a tipping point for the U.S.? So I said I think the U.S. can lead for a while, but it can't last forever. The good news for the U.S. being a global leader, though, is that actually this chart isn't only a result of the U.S. We have a whole panel on the Eurozone, so I'll sort of skim through my views on the Eurozone. But the Eurozone is certainly part of the developed market declining story. The whole approach to the Eurozone crisis has been for everybody to try to look more like Germany. And as a result, you can see we're just actually increasing the imbalances we have in the Eurozone, with Germany's current account surplus hitting record highs pretty much every month. The weaker countries also going into surplus. That basically means you kill off domestic demand in most of the Eurozone as you continue to hold wages and pensions really low. And so if you don't have any domestic demand coming out of the Eurozone, then you're reliant on exports for all of your growth. That's not a great plan in a world in which most countries are actually turning their back on free trade to some degree. So the Eurozone is hardly about to take over as the underpinning of the global liberal order from the US. Also in the UK, we have Brexit, which hasn't actually happened yet, but it is starting to bite. This is just a chart showing consumer confidence. There are also indications that the housing market in London is starting to turn. We don't have FDI data. We don't have FDI data yet because it's so horrifically lagged, but anecdotally, I know a number of asset managers that were looking to buy companies in the UK after the Brexit referendum until it turned out how it did, and then all those deals were off the table. So I imagine there's been quite an investment strike in the UK that hasn't fed through into the figures, but just wait for it. I think it will. So the UK is hardly going to take over as the global leader. And finally, we have China, which I think most people suspect might take over from the US, particularly in terms of having the global reserve currency. There are a bunch of challenges in China. I do think that there's political commitment towards rebalancing the economy and opening up the capital account and liberalizing the currency. This is just a chart showing the foreign exchange reserves to show the challenges that they're having in trying to manage that rebalancing and particularly opening up the capital account. They're having to throw a lot of their foreign exchange reserves at it, you know, they say that, so these are official figures I should highlight, so you can take them with a grain of salt to a certain degree, but at around $2.5 million US in foreign exchange reserves, the BOC gets incredibly uncomfortable and doesn't want to throw their currency at this anymore. So they do have limitations on what they can do. That being said, the Chinese government has more tools than any other government really in trying to achieve this. In addition to capital controls, albeit over an incredibly leaky economy, the government owns all the banks, so can tell them when to write down their NPLs. It's quite useful. And the central government has a pretty clean balance sheet. In terms of all this rebalancing, we'll find out a lot more this autumn at the Party Congress. And the big question will be whether President Xi is going to just focus on consolidating his own power, which is quite possible, or whether he really is dedicated to these kinds of reforms. In the meantime, the Chinese government's going to pull on all of their traditional levers to reflate growth every time it looks wobbly. So this is one of their levers, which is the property market. They can use macroprudential tools to take air out of the market and go ahead and reflate it, which you can see. So every time there's concern about Chinese growth, magically the property market reflates. So that's one tool, in addition to being able to tell banks when to go ahead and write down NPLs. They also can pump fixed asset investment into the economy. So once again, they just boost investment. I'm going through all of this mainly to highlight the big risk in China, which is their overall debt burden. It's at roughly 250% of GDP. So if China is going to go ahead and rebalance and deleverage, this is going to be the biggest deleveraging we will have ever seen, ever. And that is obviously rife with risks. The Chinese government has more tools than most, but if you start having defaults that end up becoming unmanaged and cascading, then China will face a hard landing, and there's very little chance that they'll end up taking over the liberal order in that case. In fact, they could well undermine our growth too. Just a final comment on the U.S. giving up the global reserve currency status. I think it will have to happen that way. I think the U.S. will have to give it up, in that they will get together and say, we're sick of having the global reserve currency. We don't want such a strong currency anymore. Actually, it's really hurting our model. In which case, I think we'll end up having another Bretton Woods type meeting, probably within the confines of a G20, where everybody will get around the table. The U.S. will say we don't want the global reserve currency anymore. The Chinese will say not it, we don't want it either. And I think they'll end up having to come up with some sort of international system, probably based on shared drawing rights, so that it's a amalgamation of lots of different currencies. And actually in the shared drawing rights, the U.S. is the biggest weight. So we'll still be leading, just in a different way. I'll end it there.
So I have. That was awesome. What? I don't know how this goes.
Up the slideshow,
Where? Oh.
and then along the front,
Okay, thank you. So, thank you, Mark, and thank you, Sylvia, for organizing this terrific conference. I don't have a Hillary Clinton sort of introduction, and I'll spare everybody that. The short title of my talk is Spotting Grey Swans, which borrows from Nassim Taleb's work as a metaphor for engaging in an exercise to assess the feasibility of risks or likelihood of certain political and economic events that can undermine US's position in the global economy and can expose the limits of its international monetary power. Specifically, a grey swan event or a grey swan risk we can think of refers to the likelihood of a highly consequential, if not catastrophic, event which, unlike black swan events, can be anticipated or assessed to some extent. So I'm just using it as a metaphor over here. And I argue in my paper that insofar as IPE scholars are absolutely correct to analyze the risks of grey swans that exist within the US's external balance sheet, it may in fact be the grey swans that exist internally within US's internal balance sheet that need to be considered, which can actually threaten the American monetary order to continue in seeming perpetuity. And given time constraints, I'm going to basically focus on 3 external grey swans that actually Iain and Sylvia have in their paper, which are absolutely great, and I thank them to bring valuation into IPE because it is a very important thing to focus on. So I go through those very quickly, but I argue that there is a small issue there which also needs to be considered, where structural constraints can actually make those grey swans go away, at least in the interim. I then move to considering grey swans internally within the internal balance sheet and look at how those would play out. So to go very quickly, Sylvia and Iain have 3 grey swans. I'm just going to outline those. The first one is a relatively strong dollar that they point out can make US's largely non-dollar denominated assets lose value while raising the value of its liabilities. And here, actually, this slide, which is obviously known to everybody, is the US external balance sheet. And the line to focus is the red line, which is the US NIIP or US's external indebtedness. And it is essentially the one that determines, the extent to which it can go, or financiers can start questioning it, which can affect confidence in the dollar. So the second grey swan that I outlined is that given the compositional difference between U.S. equities heavy assets vis-a-vis its bond-heavy liabilities, a crisis situation or any perception of it will raise the demand and thus the value of U.S. treasuries relative to equities, thereby pushing U.S.'s external indebtedness further into the negative. And the last one, given that there are equities and FDI holdings within US's liabilities side as well, a booming US equities market vis-a-vis other markets will again raise the value of its liabilities. More importantly, from an IP perspective, they argue that valuation changes are a result of decisions and preferences of financial market actors. And given the significant negative dive of the US external indebtedness since the global financial crisis, as is evident in the chart over here, this trend must be interpreted as the US already having lost a good amount of its autonomy to international financial markets and participant actors, thereby indicating a weakening, not strengthening, of US international monetary power. Now, I agree with all of this, and I find all their grey swans to be valid and living and thriving. But from an IP perspective, I think there is an issue that also needs to be accounted for, and one which is central to valuation. And I offer this critique with the most constructive intent. which is that valuation is not dependent on the decisions and preferences of financial actors alone. Valuation is significantly a function of interest rates, which are structural economic constraints on financial actors. In purely theoretical terms, the value of any security is nothing but the present discounted value of future returns. The main difference between valuing equities and bonds is that the value of stocks represents the present discounted value of expected future profits that vary, while the value of a bond represents the present discounted value of its fixed annuity stream of returns, including the repayment of a fixed principal amount at maturity. Regardless, interest rates hold an inverse relationship to value, and this is especially true for initial valuations in the primary market, as they are also true for valuations within the secondary market. Furthermore, the very idea of monetary policy is to maintain or raise asset values within reasonable bounds, which is done carefully by adjusting short-term interest rates, keeping inflationary expectations in mind that then affect long-term long-term rates. So if we now think of what's happening currently, in the current scenario where interest rates are expected to rise in the US after being at historically low levels for about 8 periods, this implies that the value of US liabilities must fall given the inverse relationship between interest and value. On the other hand, interest rates are expected to remain low across Europe, which is where majority of US's assets exist. Surely rising interest rates in the US also imply that the dollar would appreciate. But then again, I argue that it would be a bit premature to assume that this would simply bring in the first gray swan that they articulate, because for that to happen, the dollar would have to appreciate far more than the net positive gain that the US sees in its external indebtedness from rising interest rates. So that's a very important thing to consider as well, I think. But I agree that none of this history will unfold the way it has to unfold, and I don't dismiss any of the gray swans that exist in the financial globalization literature. But having said that, I think it's also important, given that it's an exercise in thinking about these things, to even think about what happens, what would happen in the worst case that any of the gray swans come and hit confidence. If that scenario were to happen, I think Greene points out that the dollar would plunge, and if the dollar plunges, the Fed would be compelled to actually intervene in financial markets, raise the interest rates, and use actually their reserves to go out and buy the dollars. If they can't find enough reserves, which they don't have really that many foreign exchange reserves, they can always get help from Germany and other countries, for whom as well it would be in their interest, because a weakening dollar is not in their interest. So Germany and all the other allies should be able to help out in that sense. So there is that kind of tension that exists as well. So in that sense, if that were to happen, that any of the gray swans come, the very fact that the Fed can act in this way would kind of amount to painting those gray swans white. So very quickly then, I just want to also move into the internal side of things. On the internal side, I think one place to look for gray swans is the US national debt, which now is at 105% of GDP. And this, of course, includes external debt, but does not include municipal debt or state debt. And if you do a very quick back-of-the-envelope calculation, internal debt alone comes to about 70% of GDP, and it's rising. And I think there are two gray swans to consider here. The first one is more commonly articulated, which is that high levels of debt increase the likelihood of a crisis, which, unlike the external scenario, may not simply be one of panic, where markets can be reassured with emergency measures and gray swans painted white. Unless the economy grows substantially and consistently in order for inflation to eat away the debt, it is all too plausible that US creditors will conclude that the debt is becoming unsustainable, thereby raising borrowing costs for the US. And any such conclusion on part of the creditors will impact existing bondholders, who will see the prices of their holdings drop. The Fed may try to rescue a falling dollar, but given the long-drawn nature of crises, the priority in all likelihood would be to lower rising yields to finance existing budgetary requirements.
Nevertheless, with very little room to maneuver, a bond buying program to lower borrowing costs is also going to be limited to the extent that the global economy can absorb a weakening dollar for the short term, if not the medium term. So that's one scenario. Now, in the scenario that this economic gray swan does not happen, I think there is a more serious political gray swan that needs to be considered. So let's assume that a crisis does not happen and the economy starts to grow at a healthy rate. However, for debt to wither away, inflation rates would have to be upwards of the stated target of 2% for an extended period of time. But at such high debt levels, it is simply unimaginable, at least to me, that the creditors who hold the debt are going to accept higher inflation, thereby resulting in a classic creditor-debtor standoff that Mark's recent work points to. And creditor-debtor standoffs, I argue, are going to be extremely likely within highly financialized economies like the US. This is because financialization, if we think of financialization and conceive of it as a long-drawn process of structural transformation of the economy, then it has provided instruments and methods for the upper deciles of the income distribution to now garner vast sums of wealth, but more importantly, from a political perspective, the concentration and consolidation of wealth in the hands of a few leaves very little room for collective action problems to arise within the financial creditor class. The same, however, may not be true for the vast majority of debtors for whom government services matter the most, which is why deficits need to be financed. However, as the current popular movement shows, in times of terribly unfair and unbearable inequalities, their backlash too finds expression via the electoral process. And any prolonged periods of social unrest or political uncertainty, or even periodic instances of such resulting from creditors not accepting higher inflation rates, will make financial markets question the US's ability to sustain its deficits and add to its pile. So if you look at this slide, this is a calculation that I do to actually operationalize financialization, where the idea is to, from national accounts, to cull out financial incomes. So these are financial incomes normalized by net national product. And if we look at this, both the US and UK have consistently financialized at a much higher level than their other major economies like Germany and France. So in many ways, and if you think about this, that the financialization of the US economy in particular took a hit after the great financial crisis, but then is going on a downward trend, but still remains much more than other economies. And I can explain how this measure is formulated in the Q&A, but this is essentially a measure of financial income sloshing around in an economy. So it's kind of a gross measure. But this same idea can be then extended internally to look at how the various institutional sectors fare in terms of financialization, in terms of financial incomes being drawn over time. So these are non-governmental sectors, the non-financial corporations, households, and non-profit organizations serving households, and US financial corporations. And anyone looking at this chart is going to be struck by three things. One are these straight lines. Now, these straight lines should not be taken to mean stagnancy. They should be taken to mean consistency. And given that these are financial returns, these financial returns have been adding up, accumulating, consolidating over time within the upper deciles of the income distribution. This does not include capital gains, includes mainly interest and dividends. And the second thing that's going to strike others who may be familiar with financialization's literature is that non-financial corporations seem to have taken a net negative hit from financialization measured in terms of financial income. That does not mean that it's negative profitability. It just means that when it comes to financial incomes, they're negative. And others such as Scribner and all have argued that corporations are financialized. Corporations are certainly financialized, but when you net out the inflows of financial income with the outflows of financial payments that corporations have to make, they actually come out in the negative. And over the last 30-odd years, given high borrowing costs due to high real interest rates and also payments of dividends, they come down.
And the other thing to then notice is that it's actually the households which sit right on top. What does that mean? Does that mean that financialization has been working great wonders for households? No, actually, absolutely not. And the reason for that, I argue, is because obviously the financial returns of the top deciles of the income distribution also get recorded within the household category. And I don't have distributional data within the households to present over here, but you could actually look at just capital gains. I don't use capital gains in the measure because it's not available. But for the US, if you just look at capital gains, this is the top deciles income share, including capital gains, which is the blue line, and the top decile income share of national income, which is the red line, which does not include capital gains. So the difference between the two might seem minor, but it's minor percentage points of the net national income going to just a select few on the top. So then, in closing, I would argue that it appears that a crisis as a result of high and rising national debt will certainly precipitate matters for the worse. However, even in the absence of a crisis, a standoff between the many who own and control nothing and the few who own and control most of everything in an institutional infrastructure that seems adept at reproducing inequalities, the ability of the US to maintain its current position on multiple fronts is surely to be tested. Regardless, the real gray swans to watch out seem to be the ones coming from within.
Great. So, as usual, we're a few minutes behind, but that's to be expected. So let's do about 10, 15 questions. Let's just start with Jeff, and then we'll go to Aaron.
Terrific. Thank you guys so much for this great panel. My question, I guess I'm going to aim it at Megan and Dan, but it's open for anyone. I buy Megan's story that the economic fundamentals basically point to the U.S. being sort of a 2% growth economy. I think the point is well taken. And yet we've seen this big rise in the stock market and other measures. And this strikes me as being the stock market rise being driven by redistribution rather than growth, redistribution towards the source of capital. And the political basis for that gain strikes me as a strategy of picking up nickels in front of a steamroller, right? That we've just had an election where the major theme of the election is that the working class says we're so pissed off that we're going to elect a total lunatic and put him in the White House because we've been getting screwed by the system and we're getting nothing of the gains of globalization. And American leadership has responded by saying, right, we hear you, we're going to screw you even harder by taking more of the gains from globalization and from the global economy. And so to what extent is the scenario where the US is a 2% economy, 2% growth economy, actually too rosy? Where there is a real concern of a political backlash in 2018 or 2020 or whatever, where it's not just about redistribution, but it's a whole set of new policies that for business range from bad to really, really bad. And that's the risk that I'd like you guys to comment.
Sure, I'll start. Sure.
Sorry.
Happy.
No, that's okay. I mean, this is how populism works, right? You get voted in, and the people who end up doing the worst under a populist are the ones who voted for him. So if you, for example, look at the New York Times put out an interesting diagram showing who loses the most from the new healthcare plan, and it's basically all red states. So it's mainly Trump supporters who are going to lose out the most. That's how it works. This has been tried and tested in so many places, particularly Latin America. But so that speaks to social unrest, maybe. But in terms of companies tanking as a result of policies coming through, I actually think that's pretty unlikely. If we do end up getting some kind of tax cuts, and I think we will, and we do end up getting some repatriation, and I think we'll get something. It might not be as grand as what's being promised. I do think that will be generally good for business. There's a risk in the deregulation piece, in that the idea is to just get rid of Dodd-Frank. It's not going to happen. And having spoken to someone very senior at the American Bankers Association, they're not expecting anything to happen with Dodd-Frank until 2019 at the earliest. So we're going to have to wait much longer. But if we were to repeal Dodd-Frank, of course, Dodd-Frank was put in place to address the bubble that arose that caused the global financial crisis. So if we strip a lot of that away, in the short term, that will be great for the financial services industry. But we could be creating, or at least laying the groundwork for the next bubble that could end up being the next global financial crisis. So that's a risk. But generally, the biggest potential cause of a U.S. recession, I think, is geopolitical. And that's the one thing that no economist can possibly forecast or bake into their models, so nobody is. But I do think geopolitical risk has increased off the back of this election. We just don't know where a conflict might break out or when exactly. But I think that's the biggest risk for a U.S. recession.
A, what she said. B, I would say a few things on this. The first is that you have to be very careful about what kind of populism you're talking about. So you can argue the distinction between the sort of populism that drove, let's say, Bernie Sanders versus the populism that drove Donald Trump is rather different, actually, and that the populism that drove Bernie Sanders would be hostility to Wall Street, hostility to, to plutocrats, as it were. I'm not sure you can make that argument with the populism that drove Donald Trump. I mean, I've seen a lot of pretty cogent analysis suggesting the hostility, the right populism is more hostility to people like you and me, which is hostility to professionals. And that's very different from rich people. And in some ways, that is the way in which you can, and let's face it, unfortunately, yes. And that's the way in which Trump can, the Trump administration can potentially, at least on the rhetorical side, have its cake and eat its too, which is to say, we're going to represent the common man, but the way we're going to do it is by bringing in really rich people, and we can tell they're really smart because they're really rich. And that's why they should be put in charge. But the bigger issue, I would argue, is that it's not obvious to me that any policies are going to be implemented that will actually cause anything to deviate from the 2% growth. I mean, you can point to AHCA, but that's not going to pass apparently from everything I've seen. So there's not going to necessarily be any significant health care. There might be a tax, I would assume, would be the one thing that will get passed between now and 2018. Even on trade protection, you're not actually seeing TPP got ended, but you're not. China hasn't been labeled as a currency designator, or hasn't been designated as a currency manipulator yet. U.S. hasn't pulled out of NAFTA yet. That doesn't mean these things can't happen, but that's actually the one area where I do think corporate pressure would constrain Donald Trump. I don't think corporations, with production chains across North America want NAFTA to end. If you want me to be scared, my worry is that the deviation from 2% is not over the next 2 years. It's after the midterms. Because if you have a midterm election where suddenly people are pissed off because Trump hasn't done anything that he's promised, you have this Democratic wave that winds up controlling the majority of Congress. The one area where you would have some degree of commonality is on trade protectionism. That actually worries me. I'm not worried about anything else after that because then you just have gridlock. Then the sort of dynamics that Sylvia and Iain are talking about, then that might actually kick in. And then I would have concerns about that. But really the one thing that would concern me is if you had this sort of Sanders-Ista wave in 2018, and the one thing it turns out they can agree with the Trump administration on is trade protection. That does disturb me potentially. But that's also, I'm not sure that's necessarily even going to happen. And even if that does happen, I would point out that it wouldn't shock me if at that moment the Republicans then switch back to their free trade roots, which they claim they always held right up until the 2016 election. At which point, you've got a blocking code. They still have veto power in the Senate, so I'm not even sure even there something would necessarily happen.
So I wanted to comment on the latter half of Sylvia and Iain's fascinating paper. And I love the disaggregation of the liability and asset side of, say, the emerging market dollar exposure. I wanted to push you a little bit further. If you take 2008 as a kind of test run of this, there's two other things that really matter about that balance sheet. First of all is who's owing the liabilities and who owns the assets, so sectorally. And the other one is the term structure of them, right? So if you take Korea as the classic instance that the BIS has used to diagnose the 2008 dilemma, Korea looks like it has a very healthy dollar position. When the dollar strengthens, it should be a winner, and overall it is on the net balance sheet. It's just that the dollar assets are long-term and held by sovereign wealth fund type actors, and the liabilities are short-term and held by the private sector because their banks are running the classic funding model of the new banking age. And that produces a very near miss in Korea, necessitating an unprecedented swap line arrangement. So it seems to me that to really think through the politics of this, that would seem to move it from a sort of wrinkle to a substantial and major change in the quality of the argument. Whether Japan or whether Germany, quote unquote, has an interest in this depends on who you're talking about and how those domestic coalitions are organized. If you can organize, as the Koreans eventually do, the kind of transfers internally that stabilize it, then the sense in which they're a net winner, you could actually cash it out. But if you can't do that, A, you've got a bunch of losers, and their losses could be so catastrophic that they're tipping point losses and your banking system goes down. So those would seem to me to be crucial kind of developments of the direction that you're driving.
Right, so to really build out a politics of the external balance sheet, you have to look at the intranational sectoral interests. And, so listening to Puneet, those households that are gaining, whether it's from cap gains or dividend, what's their balance sheet like? Are those U.S. assets or are those rest of world assets? Right, the data challenges of doing this are quite significant, and we're looking at currency mismatch in this paper. You're talking about maturity mismatch, which is obviously another source of risk on a balance sheet. And again, we could probably get more purchase on that than the whether U.S. households are predominantly owning U.S. assets or foreign assets. But we are absolutely shopping for help figuring out the data challenges of extending this argument further. So any ideas you have about data that we could use and ways we could, newly slice it.
The label it seems to go under in the Bank of England is who. It's this great Leninist slogan which has now been adopted for national
But I'm sure Iain wants to say something quickly.
I was thinking about A, what she said. B, I think what you point to, just in terms of broadening out the politics and Trump, etc., is, to me, the only question that really matters on the future system is the one that Eric Helena has raised. I don't think it's been published yet, but imagine what would happen if the Fed, and remember the US Treasury with money market mutual funds, etc., did what they did in a future financial crisis under this president and this Congress. What would we expect to happen? And to me, it goes back to career and your short term, etc. To me, that's the only question ultimately that matters in terms of the future of the system. Not the foreigners giving up, but the US.
Yeah, which is Megan's point.
So we have Jackie and then Jonathan.
I just had it's more of a reflection, I guess. I was just sitting back thinking about reviewing my notes here, what you guys had talked about, and it just one of the things that struck me as we're talking about this question of American financial hegemony and the future of American power in that context. That actually, there are at least three different conceptions of power being talked about here, and I think that's part of what's so interesting. That we have Sylvia and Iain really speaking to American autonomy in relation to private authority. And I don't know if you speak a bit more about how you're conceptualizing that, but thinking that part of what's going on is actually not necessarily a state-to-state transfer, but a different kind of shift in the forms of authority and what kinds of implications that has for American power. And then Dan, obviously we have Susan Strange, which is great, structural power, but also we have much more of a sense of strategic, the possibilities of rational act states as rational actors thinking this through and making, deciding on how they're going to play this out. And then finally with Puneet, I think what we see is domestic power and the fact that actually states are also in many ways having to come to terms with domestic class and other forms of tension, conflict, and so on, that the possibilities for maneuver globally are always also to some extent constrained by those factors. So that for me just struck me really clearly. I'm sure you also said something, Meg, when I was looking through. I love your presentation. I didn't see clearly a conception of power there, but I thought here, I think when we're thinking about this, we actually, all of these pieces are important, but they all, frame the possibilities in different kinds of ways. Just throw that out.
Jonathan.
Thanks. I had one question and another two, and they're not so much questions as general comments. The first one, in response to Ian's last comment about the central banks in the next crisis. Just as general, something for us to think about. I assume they won't / can't, and that's going to matter in a huge way. So we might want to have that as something that we're thinking about. because that's going to be a bad thing. But that wasn't. But my main question was I wanted to ask Dan, and actually I think we're not. I agree with most of his paper. This is more of a musing. On your phrase rational revisionist, this is another technical question. I like the phrase, but your conclusion was that they would, so they go money last. And I follow the logic of that. But there's also the question of, is that also might be the sphere in which purposeful policies by revisionist states matters least. So that as a state, you can raise tariffs up or down when you get up in the morning and roll out of bed. Or you can reorient your foreign policy to be a little more kind of difficult. But in terms of choices about using money globally, there's a larger role for kind of diverse, disparate, and private actors. And so shifts we may see may not derive first from purposeful actions taken by state.
Okay. Well, I would say, let me put it this way. That's an interesting point, and I think in general you might be correct. In the specific case we're talking about, which is the U.S. and China, I don't think you're correct, though, because China actually, the Chinese government does have a series of explicit steps it would need to take before any private actor would look at China and think, yes, that actually is a market where I would trust it producing the reserve currency. So I would push back on if we were talking about a different time or a different place, I think that's a valid argument. But I don't think it applies to China, which is, I also think, the only actor that can really potentially propose something that is genuinely a sort of radical change. What was your first question? I can't remember.
No, my first question was on the...
Oh, right, yeah. Oh, wait.
We were disagreeing so much as I wanted to put on the table for our general discussion.
Yeah.
Right, that in this sphere, there's more power in the hands of non-state actors than in many of the other kind of revisionist spheres that we would look at. And so when we're thinking about the future of the international monetary system, that's something just to keep an eye on.
That I grant you. There's one last thing I want to say on this question, though, of whether if there was a crisis, would the Trump administration wind up backstopping what would happen. I'm going to point out that when 2008 happened, you had a president with what, I think a 25% approval rating by the end of that crisis, was generally thought to be a lame duck, and by the way, was ideologically opposed to the idea of intervening, to save financial actors, because that demonstrated a whole moral hazard problem. And yet, nonetheless, it actually happened. So you now have a president with even less ideological rigidity on this issue.
Democratic majority in both houses.
Yes.
The president was in favor of that.
What? Right. No. The president support. Right. But right up until the moment that the crisis actually emerged, is my point.
American officials didn't realize it was a solvency crisis.
All I'm saying is that there were ways in which you would have thought that there is no way the Bush administration would have signed on to this ex ante back in 2007 or early 2008, and yet in the end they wind up embracing it. It would not shock me at all if the Trump administration decided this is something we absolutely have to do. And even if you have the House Freedom Caucus saying under no circumstances whatsoever are we going to support this, you would eventually have a coalition in Congress that would wind up backing it.
And rounding it out before we get some coffee, Kate.
Great, thank you. So just sort of two-finger maybe on this discussion. I think one of the things that was going around in my head as I listened to all these really interesting papers is that we need a better understanding of the sort of lag in the transition to the international reserve currency. If I remember my history right, the British pound sterling, really sort of outlasts British actual sort of capacity, both politically and economically, in its hegemony. And I've written, I guess in 2008, I wrote a piece about why the euro will not actually become the international reserve currency, despite Jay-Z and Giselle, using it for things. And I talked about the notion that these plethora of actors in the international system, private actors and so on, need a sort of constructed focal point, right? That in fact, the reason why these things are so sticky is because it does involve this sort of social construction of an agreed focal point of the international reserve currency. And that takes a lot of work and tends to also require, in a Susan Jones way, right, this underlying kind of Gilpinian sort of power structure. But I feel like I would really like to understand better how to think about, since I think many of the memos agree, the US as the global financial hegemon is not going anywhere immediately. I think we do need a better sort of theoretical and historical understanding of how those lags happen and how those switches occur. And again, I suspect, people in this room have done a lot more work on this than I have, so I hope we can continue to discuss that.
All right. At that point, just a little note on the importance of infrastructure. It's fallen apart as far as the Northeast Corridor is concerned. There's been a derailment, and Branko Milanovic may not be joining us this afternoon as a consequence. So I want to see some Trump-like infrastructure investment happening soon. Because this is ridiculous. I just got a message from him directly. So some trains have been cancelled. So in the meantime, coffee.